Hello and welcome Optuma users to this video number 4 in our 6-part educational series from GoNoGo Charts. My name is Tyler Wood. I am a CMT charter holder, and as always, I am joined by Alex Cole, the chief of charts over here at GoNoGo. How you doing, my friend?
I'm very well, thanks.
So, if you've been following along in the first 3 episodes of this series, you've heard us talk a lot about the difficulty with technical analysis. What we're going to discuss today is the interplay between trend and momentum. So, all of those concepts that we talked about in videos 1 through 3, the practical application of how we can use that to our advantage as trend following investors. Now, here at GoNoGo Charts, we know that the information provided by a number of different technical indicators can be very powerful. We get to see a weight of the evidence. We have a responsible checklist for how we identify trends and momentum. However, that problem with technical analysis is that when we develop a robust checklist, if we add indicator after indicator, multiple panels to our chart, we can introduce indicator overload or analysis paralysis. That brings back all of those behavioral biases we're trying to steer clear of and remain objective and quantifiable in our approach. So, Alex, let's talk a little bit about that complete solution from GoNoGo Charts, just as a quick refresher.
Absolutely. And as you said, what we're trying to do is keep all of the information that we need, take a weight of the evidence approach using a discipline checklist, but keep the chart as simple as possible. So you've seen how we do that when we're looking for trend identification. We've got the GoNoGo trend indicator that blends some of these foundational concepts of trend following into an indicator that color codes the price based on the strength of that trend. And if we can do that, of course, we can profit on that movement in price. We've also talked about momentum concepts and how we can take the same approach, blending those objective and sort of tried and true concepts of momentum analysis into just one indicator again that gives us everything we need in terms of identifying levels of overbought and oversold, in terms of divergence analysis. But we also are going to touch on today how the oscillator interacts with the zero line and how powerful that can be when using momentum ideas within trends. And that leads us to then a discussion of these GoNoGo icons, which we're going to talk about, and GoNoGo squeeze we'll get to in a later video.
Excellent. So before we dive into the practical application, let's just talk a little bit about what we're trying to do as trend following investors.
So we want to participate in trends. We don't want to anticipate. We don't want to try to predict. There's people out there in our industry always sort of, here's what's going to happen next. If you know what's going to happen next, more power to you, but I'd be wary of those individuals. We want to remove any doubt or confusion and definitely uncertainty so that we can remain objective. And we do that by having a checklist that we've talked about and by sticking to our rules. And if we can do all of those things, we hope then that we're going to act responsibly and without emotional bias.
So this is where it gets really powerful, right? We've all heard about trend following. We've probably seen some TikTok traders telling us to just buy the dip, right? Things are just going to the moon, and irresponsibly buying into selling pressure in the markets. However, as trend following investors, we can maximize those returns, right? We can hold with our trending securities longer than other investors, avoid some of the emotional pitfalls that urge us to lock in a 10 or 15 or 20% gain. And we do want to be objective about our risk management. We've talked a lot about that in the first 3 videos. So to get mathematical about our equity returns, we can look at the expectancy formula. And this is going to be the efficient frontier. This line that I'm highlighting here with the laser pointer, that's where portfolio managers break even. And all we're looking at is the combination between the percentage of winning trades and the profit ratio therein. So let's just pick on one dot for a second. This is a 50-50. So imagine you had no analytical discipline whatsoever, no tools at your disposal, and you're simply flipping a coin, whether you buy or sell a stock. So if we flip a coin and we grab that security, put it into our portfolio, then our risk management discipline, our money management practice can still help us break even if we make sure that we're letting winners run and cutting losses short. That's really simple to say out loud, very difficult to execute. But I also want to point out that for a lot of trend followers, the expectancy of their percentage of profitable trades might be a lot lower than you think. Consider Major League Baseball. Those who make it into the Hall of Fame are batting 300. Well, that means they're striking out 70% of the time. And what they're doing is making sure that they control risk very, very tight, very small losses. But when they have a trending security in their portfolio, they can really lean into that position. They can press their bets, so to speak, and they get these maximum outsized returns. So with GoNoGo Charts, we want to improve not only our strategic edge in our analysis, but also our money management discipline. And that's what we're going to talk about today with that interplay between trend and momentum. So Alex, one more quick review. As we talked about in video number 3, let's just review those momentum concepts.
Yeah, man, I think we've talked about it enough, but just to quickly highlight the point that this information is valuable. We're both strong believers in technical analysis, and we've researched the works of so many great pioneers in our industry. So we want this information. But as you can see, when you add multiple indicators to your chart, it becomes complicated. And if you imagine now that you're adding some of this to our trend identification chart that we looked at in video 1, now you're really you're getting sort of left with a chart that makes it very, very difficult to see price action, to see areas, key levels of support and resistance and the like. So we want momentum concepts. We know how powerful they are, but we don't want to complicate our chart.
So as George Lane introduced stochastics in the 1950s, or Wells Wilder introducing RSI to the world in the 1970s, they were looking at some range-bound market activity. Now, other authors and incredible technicians like Connie Brown and others have used momentum concepts in trending environments. So let's take a look at the GoNoGo chart, and let's just think about this interplay. When I first started working for the CMT Association over 12 years ago, Ralph Acampora came into the office, and we were looking at these walls in our library that were covered with hand-drawn charts from his old technician's war room. And I, of course, wanting to show off in front of the godfather of technical analysis, I said, "Oh, Ralph, right there, RSI is overbought. There's the sell signal." And he said, "Oh, Tyler. Quick review on momentum." And here's how he explained it to me. He said, momentum is like a baseball in your glove. Ralph's, of course, from the Bronx. Everything with these guys is baseball. He said, consider momentum as the speed of the ball. And when you throw it up in the air, it's going to move fastest right when it leaves your glove. And then it's going to travel up into the sky. It's going to reach that apex, the highest point that you've thrown it. It's going to decelerate even as it's climbing higher. And then what's it going to do? It's going to come back. Gravity's going to pull it back down, and hopefully you catch it in your glove, and the game of catch can continue. So let's use that analogy when we're thinking about trend following. We know price doesn't move in a straight line. We're going to have surges and pullbacks, and it's going to take the stairs on the way up. Well, with GoNoGo charts, what we want to identify is this area of neutrality for momentum. And we have an objective zero line. One of the difficult things that Connie Brown and others found was that it's difficult to translate what is neutral. Where is that objective zero line of support for momentum? So we've built that into the tool. Now, as we're seeing a Go trend continue, we can watch the GoNoGo Oscillator surge into overbought territory and come back down. And where it finds support at the zero level, that's where Tyler catches the ball in his glove. Hopefully he doesn't drop it on the ground. The game of catch can continue. Momentum resurges in the direction of the underlying trend. That's what's most valuable to trend followers. When we think about sticking with a position, or maybe even pyramiding our position, adding to our position size, leaning into those securities that are working in our portfolio, we can use these trading rules to our advantage. So Alex, when we see that surge of momentum in the direction of the trend, right, where it comes back to neutral and finds support, continuing on with positive momentum, that's where we're going to call this out with some unique data visualization. Let's talk a little bit about GoNoGo icons.
Yeah, I mean, we're really big believers in data visualization. We know that our eyes can analyze data perhaps quicker than our brains. In my case, anyway. I don't tell my dad, he's a math teacher, but I like visuals much more than I like numbers. And so what we want to do is call our attention to important moments using some kind of visual. And even though we've tried to keep the chart as simple as possible, you can still improve the way you interact with it in terms of where your eyes are focused. And so we've got a couple of different icons on this chart. The first one are trend continuation icons. And what you see here are green circles when the trend is likely to continue. How do we know it's likely to continue? Because Tyler didn't drop the ball, right? That's what we're looking for. We're looking for that situation where momentum has surged, it's come back down to the glove or to the zero line in our case, and it has found support. So when the oscillator finds support at the zero line, we're going to highlight that with that icon on the chart, telling us that we can be fairly confident momentum is resurgent in the direction of the underlying trend, which of course in this case is a Go trend. The second type of icon that we've got on here are counter trend corrections. And that's important because of the value that we perceive from using an oscillator in its traditional sense. So you can see that when we've had an area of overbought extremes and then it's come back into neutral territory, we're going to say that's a counter trend correction situation where price may struggle in the short term to go higher. We're not calling for a reversal at that point, but just that momentum has been very quickly moving in one direction and has cooled back into a more neutral kind of territory.
So if you're thinking about your own trading practice, when we see these counter trend correction arrows, it's not a sell signal, but it's a logical place where we might see a short term or an intermediate period high. So if we need to take some of the assets out of our portfolios, maybe deploy capital towards other securities that are trending, or if there's even just a liquidity event in your own life or for your clients, that's a logical spot to move some money out of those positions. Now, we've obviously built these tools that name itself suggests go or no go with a long only bias. But we've also built these tools to work in both directions. So if you trade to the short side, if you're a futures trader or work in derivatives, you can certainly use GoNoGo charts to lean into short positions when we're in a no-go trend. And the exact same rules apply. Here we are in a no-go trend. This is a chart of Uber. We're seeing pink and purple bars, the weak and strong form of the no-go trend. And what do we see with GoNoGo Oscillator? It's in negative momentum territory, moving down to oversold and then back up to neutral. Every time it gets to neutral and it finds resistance and is rejected back lower for surging negative momentum in a downward sloping no-go trend, we can lean into those positions. So we're calling those out with GoNoGo icons in the exact same way. The circle icons, red in this case for a no-go trend, are telling us those points of trend continuation, momentum resurgent in the direction of the underlying trend. Same thing for the counter trend correction arrows. Here we see that momentum has gotten to an oversold condition and then loosened up back to towards neutral territory. That might be a spot where you start to cover some of your shorts or consider some of your risk management discipline. So from all of us at GoNoGo Charts, I hope this educational series has been helpful to you, not just in how to use GoNoGo Charts, but technical analysis broadly and some of these very powerful concepts that we've learned over the years from some of the best technicians in the space. If you have any questions for Alex or I or the whole GoNoGo Charts team, feel free to shoot us an email, info@gonogocharts.com. And until next time, in video number 5, where we talk about volatility squeezes, I want you to take care of each other and trade them well.